It's no secret that history repeats itself. And in the stock market, nothing spreads faster than the delusion that risk has magically vanished. Investors will twist reality, ignore danger, and perform Olympic-level mental gymnastics to convince themselves that this time, surely it's different. Sir John Templeton, who averaged 15% annual returns for nearly 4 decades, called those the 4 most expensive words in the English language. He was not being poetic. He was being literal, because nothing empties a brokerage account faster than wishful thinking dressed up as a financial strategy. Which brings us to a part of market history almost no one talks about anymore. A bubble that didn't inflate around housing or tech stocks or crypto, but around volatility itself. A bubble so bizarre, so quietly dangerous, and so fast-moving that when it popped, it nearly broke the entire stock market in a single trading afternoon. This forgotten event has a name people say jokingly but will never fully understand. Volmageddon. And the reason we're talking about it today here is quite simple. It's happening again, and almost nobody sees it. The story begins in the years following the 2008 financial crisis. The world was wrecked, unemployment was high, banks were radioactive, consumer confidence was in the toilet, so the Federal Reserve stepped in with the financial version of duct tape and superglue. They cut interest rates to 0, they printed trillions, and they promised the market something it had never truly had before. Stability. From 2012 to 2017, volatility didn't just decline, it simply collapsed. The VIX, the market's fear index, hit the lowest levels ever recorded, and it basically just stayed there. If volatility is the heartbeat of the market, then during these years the market flatlined. Basically no heartbeat on this mug. Investors looked at this new calm environment and convinced themselves of 2 dangerous things. 1, that the Fed will never let the market fall again. 2, volatility is permanently dead. 2 of the wisest statements I've heard in quite some time, and that belief created one of the most quietly insane bubbles modern finance had ever seen. Here's where it gets insane. A group of institutions realized they could make products that didn't just observe volatility, but bet against it. Enter the inverse volatility ETF. Names like XIV, SVXY, tickers. To retail traders, these products looked like a cheat code. On paper, you could just print money. The logic seemed quite simple. If volatility keeps going down, why not profit from it? We're in a time period where volatility, it just seems to get lower and lower. Why not create a product that we can bet on and make billions? Let's do this. These funds skyrocketed. XIV gained over 600% in just a few years. People were calling it free cash, free money. Wall Street blogs said it was the easiest trade on earth. Simply just short volatility because that's the only direction it goes is down. Surely, right, Wall Street? But here's the thing about markets. If something sounds like a no-risk ATM, it's not a strategy. It's a grenade with the pin that has already been pulled. Because inverse volatility ETFs weren't like normal stocks, they didn't just track volatility, they interacted with it. They used complex derivatives, daily rebalancing, and mathematical models that worked beautifully until they didn't. Jesse Livermore, one of the greatest speculators of all time, once said, "There is nothing new on Wall Street. There can't be, because speculation is as old as the hills." And Volmageddon proved him just right. Then came February 5th, 2018, the day that will live in infamy. A normal Monday morning, it seemed, nothing unusual. Skies blue, grass green. The market was already slightly shaky from a small spike in wages and inflation fears. The S&P dropped 2%. Not ideal, of course, but not catastrophic. But for volatility products, that 2% drop was the equivalent of lighting a fuse. The VIX, which had lived below 11 for months, and just for reference, I am a trader of going on 5 years. A VIX 11 is astonishingly low. If you're looking at a market and looking at a 5-minute chart, it's likely to look very, very up and down, just staying in the exact same spot. Now, this VIX, however, started rising 20%, 30%, 40%. Traders shrugged. Happened before, no big deal. Then the models kicked in. See, inverse volatility ETFs had one crucial, fatal flaw about them. When volatility rose, they were forced to buy volatility, which made volatility rise even more, which forced them to buy even more, and so on. And so it was essentially a feedback loop, a death spiral, like a thermostat that, instead of cooling your house, decides to make it hotter because it already feels warm. Within minutes, the VIX exploded. I mean, I'm talking catastrophic here. 50%, 80%, 100%, 120%. And keep in mind, because these hedge funds were so balls deep in these volatility instruments, they were continuously buying more volatility, which made volatility spike even harder. It was a complete and continuous autonomous death spiral. It was glorious, really. This wasn't normal volatility. This was panic. This was the financial equivalent of a heart attack. XIV, the biggest inverse volatility fund, collapsed by over 95% in after-hours trading. Retail investors, guys like you and me, woke up to accounts wiped to zero, margin calls, full liquidation, and most importantly, no warning. One trader lost $4 million in 5 minutes. Another, interviewed by Bloomberg, said, "I didn't even know it could go to zero." And let me tell you, ladies and gentlemen, it could, and it did. This was Volmageddon, a $1 trillion market structure cracking in real time, and Wall Street swore it would never let it happen again. But here's the problem. They didn't stop the behavior. They just changed the vehicle. There was nothing ever truly done to prevent something like this happening, just copy and pasted in a different suit and tie. Essentially what I'm saying is, it's happening now, disguised as some other financial instrument. Here's the part nobody wants to hear. Today's market looks even more fragile than it did in 2018. Sure, inverse volatility ETFs were mostly shut down. XIV was terminated because it was liquidated in one trading session. SVXY was neutered, balls cut straight off, and regulators pretended they solve the problem. Sure, but the core issue, the root cause, that didn't go away. It simply evolved. Now the danger is hiding in zero-day options, or 0DTE, retail option sellers, massive institutional hedging flows, call selling, and record levels of short volatility positioning. In 2017, it was inverse ETFs. Today, it's options, but the dynamic is essentially the same. Billions and billions of dollars betting that volatility will stay low forever, and just like 2018, if volatility spikes even a little, the hedging will make it spike more and more and more. A doom loop, just wearing a different outfit. Mark Twain once said, "History does not repeat itself, but it does often rhyme." And right now, it's singing. Here are the real numbers, the ones nobody on CNBC will show you. 0DT options now make up over 55% of total S&P options volume. This number was, just for reference, 5% back in 2017. See the correlation? You seeing it? Over $250 billion in notional exposure is traded daily in contracts that expire within hours. Retail traders have sold more put premium in the last year than in any year on record. Institutions are running the largest short volatility books since, you guessed it, drumroll, 2017. And when volatility spikes, Goldman Sachs estimates that dealers may need to buy $15 to $30 billion in futures per 1 point of VIX movement. That is the same feedback loop that caused You guessed it, Volmageddon. Same setup, same incentives, same free money mindset, just bigger, more explosive, more fragile, more degeneracy. Now, back in 2017, the market believed volatility was dead. People said the Fed has our back, the market only goes up, selling volatility is safe income. And in 2024, 2025, we're hearing the same bedtime story. The only difference is the packaging. You don't need XIV to recreate Volmageddon. You just need enough people selling short-dated options in a low volatility environment and believing nothing bad could ever happen. Warren Buffett once said, "What we learn from history is that people don't learn from history." And once again, investors are whispering the four most expensive words in existence. This time, it's different. Volmageddon wasn't just a freak accident. It wasn't a glitch. It wasn't a once-in-a-lifetime event. It was a preview, a trailer, a warning shot, perhaps. And today, the sequel is already being written quietly, invisibly, in billions of dollars of daily option flow. The question isn't whether volatility will return. It will. We know it will. The question is, when it does, how many people will pretend they weren't warned?